Let's get more on the stress tests and the bank trade with RBC Capital's Gerard Cassidy. He's the head of U.S. Bank Equity Strategy and the large cap bank analyst. Gerard, any surprises, any questions that still remain in your head?
No, actually, the results came in quite nicely. Once again, the industry, as you opened up in your segment, is very resilient. They have enormous amounts of capital to handle a really severe downturn. And one of the major risks that we hear from investors today is that they're worried about credit losses going higher. And what this test shows us, that unlike in '08 and '09, when 18 out of the 20 largest banks cut or eliminated their dividends, that's not going to happen this time. These banks are well capitalized. The dividends are going to be safe through the downturn. And I think that's going to show up as people start to realize that.
Gerard, it's Karen. Thanks for being on today. As a long-suffering, I guess, bank holder, what do you think it will take to get the sentiment around these bank stocks to lift?
Oh, Karen, you're spot on about the sentiment. It's quite negative. I've been in Boston all week visiting with investors. They're either apathetic or they just don't want to move into the banks. And the inflection point we are looking for is net interest income growth. People don't realize that rising interest rates, you touched on it in your comments, Karen, about the margin expansion. You are going to see amazing numbers. We're forecasting Bank of America could have 15 to 20% revenue growth this year in net interest income because of the rise in rates. So I think what investors need to see is that as this revenue growth comes in better than expected, especially in the third quarter, when you're going to have the full impact of the July Fed funds rate increase as well as the June that we just had, it's going to be very powerful. And at the same time, people are going to see that the credit quality for the banks, they have de-risked these balance sheets because of what we're talking about today, the stress test. The real risk is outside the banking system. So I think once people realize the credit is not that bad and the revenue growth is real strong, that changes the sentiment, hopefully in the latter part of the second half of this year.
Gerard, I think you were listening to the beginning of the show. We mentioned Deutsche Bank being down 11%, 52-week low. You know, the Eurozone collectively, the largest economy on the planet. Obviously, Germany, I think the fifth largest. Not an insignificant bank. I'm not asking about Deutsche Bank, but how worried should we be that there's potentially something more there?
It's interesting because obviously, you know, Deutsche or Credit Suisse have been struggling for years. Both those companies have had challenges that are somewhat unique to them. But there's always, you know, the worry that there could be, you know, the second derivative risks to other banks, counterparty risks. But that's what this stress test does, as you guys know. It takes not just into account the losses in credit cards or commercial real estate, but it takes into account trading losses and counterparty risk losses. And that's what's so, I think, positive about these results is that all our banks come through it. Yes, they're going to have lower earnings, no doubt about it, in a severe scenario as described by the Fed, but they come through it with healthy capital. But yes, when you see stocks settle off like that, as you point out, Guy, it is really something to keep an eye on, especially with a bank that large.
So, Gerard, it's Tim. Have banks therefore priced in at least the expectations in the same way that the market has on recession? And again, I'm talking about credit quality and places where banks are going to have to reserve. What do you think about valuations right here relative to the environment you see?
Yeah, no, I think you're right. They have priced in definitely some part of a recessionary environment with higher credit losses. The valuations look to us to be attractive. Now, they're not as cheap as they were March 23rd, 2020, and I'm not suggesting we're going to get that low, but they're off the highs that we saw in January when the banks, as you guys know, month to date in January, the index was up 13% and has obviously come off dramatically since then. But when you look at bank stocks trading at just above book value on average, or 1.5 times tangible, they start to get interesting, especially if we hit this inflection point, as Karen and I were talking about, that you can really see, you know, people coming back into the stocks. They're under-owned. Sentiment is obviously not positive. And I think at these valuation levels, yes, there's limited downside from here. But I think as people realize the banks are just not going to have the credit issues that they had in '08, '09, that's going to be the real rallying point for owning these names.
And that's a benefit of the stress test, Gerard. It really gives us a snapshot into how these banks will perform in such downturns. But just can you give us some historical context in terms of what the stocks have done in past recessions?
Sure. I mean, when you look at 1990 and 2008, 9, the bank stocks were hit extremely hard. They traded down to respectively approximately 50% of book in 1990 and about 43% of book in 2008, 2009. In 2001, which is what we're thinking this is going to look like, the banks never broke book value. You know, the problems in 2001 were the dot-com implosion. It was a financial problem, not a credit problem. And that's what we think is going to happen this time. It's the problems are outside the banking industry. You know, the Fed with QT, they created such an asset bubble with QE. Now they're deflating it. So the problems are going to be in the financial markets more so than we believe, more so than in credit. We don't think it's a credit debacle that's going to get us this time. It's going to be more the deflationary asset prices that Chairman Powell talked about yesterday in front of Congress.
Gerard, great to get your take. Thank you so much.
Thank you, everyone.
Gerard Cassidy, RBC. Tim, what's a trade here?
Well, I think money center banks, first of all, within this sphere of banks and insurance companies look the most interesting because I think they're actually the most defensive. I'm worried about some of the interest rate sensitivity on the regionals. I'm worried about some of the credit exposure with some of the consumer finance companies, and a lot of those companies are painted with a high multiple brush. So, again, I would look at a price to tangible book in a Bank of America around 1.1, very attractive, back down near those levels that you've talked about with a company that, to me, has the most exposure across the core businesses. I realize mortgage exposure is one of these things that has been a major tailwind for these banks. Bank of America is right there, but I think of the money center banks, that's the one that has the most balance and the valuation that's the cheapest.
You know, it's interesting, right? We're just kind of the early cycles of this, right? The stock market topped out in January, right? So here we are, we've just 6 months into it, and we know that large parts of the market have been topping out. But when you put it all together, you think about the likelihood that housing is going to do a similar sort of turn that we had in the S&P 500, maybe it's down 10, 20% or something, that activity is already going to slow down. You think about a lot of these other places where some of these money center banks do. It just doesn't seem like a great environment. So you can talk about how cheap they are. You know, you just said you're a long-suffering bank. I'd rather go with a Goldman where Guy just mentioned that they're going to trade their way out of this. I mean, really, if you think about it, and then they'll be well set up if at some point in 2023 a lot of that capital markets activity comes back, right? If the IPO window's open, if we start seeing M&A, I mean, that's what they're really good at. So to me, I don't find the money centers that interesting right now. No matter what spread you're focused on for net interest margins, it just doesn't seem like a good environment right now.
I mean, Karen, you mentioned sentiment, and that's the banks have been wrapped up so much in just negative sentiment toward them. If there is a recession, that's not going to be good for sentiment in any way.
Yes, I don't imagine the sentiment will lift. Yeah.
Right, exactly.
Yes, I agree with you there. I do think, though, if we are in a recession, I think that what's going to work in the market. So not the high flyers. I don't think those are going to work. And ultimately, I think there's a place for value. And if you look at some of the value ETFs, some of the biggest exposure they have is banks, right, because they are the cheapest. And with the security that they have now, given how strong their balance sheets are, I don't think this is going to nothing remotely like 08-09.
Yeah, JP Morgan down 35% from that high we made just as Dan point. I mean, that's a pretty historic move to the downside. Again, just to reiterate, I do think Goldman can. You think about what's taken place in this quarter specifically, some of the trading activity, it all lines up for what Goldman Sachs done. Now, will they get rewarded for that? I think they will post earnings, not for the long run, though.